Welcome to the Killick & Co podcast on the 24th of February. Just a quick look back at last week to say that markets were generally quite quiet. It was half-term week, and so some of the volume declines last week were put on the half-term scheduled holiday. But we also had developments in the Ukraine, which whilst not impacting in terms of financial markets, other than, of course, in CDS spreads on the Ukrainian debt, for example, there are implications, and European leaders, envoys that are over there this week, really trying to sort out a bailout on the Ukraine and support there at the moment, know that this is going to cost a lot of money to put right. So, and indeed, attention will continue to focus back on Europe. And indeed, this week we do have inflation data coming out from Europe, which is telling a tale of declining rates of inflation, worryingly so, certainly less than 1% inflation across the Eurozone at the moment, and potential worries of deflation, certainly in some of the weaker parts of Europe. The Financial Times leader running ahead again with the fact that they want to see more action out of the ECB to address that situation. So that inflation data out on Friday. This morning, really just a key feature of this morning's markets, a little bit of softness overall in equity markets, but confirmation this morning that Carphone Warehouse and Dixons are in merger discussions at the moment. They are preliminary, and indeed they were outed by rumours that were circulating on some of the chat boards this morning and in the press. These two companies share very similar market capitalisations of around £1.8 billion. There's a lot more turnover at Dixons, and it is a much lower margin business, but they talk about putting these two businesses together to create obviously the leader in the electronics retailing space. So let's look forward to the week ahead and focus on some of the areas for us to focus on this week. In highlighted companies which we do have an interest in, results out from Baidu. Now this is the Chinese equivalent of Google. It is the search engine of choice in the China market, Chinese market. These shares are listed in America, and we have a buy note out on Baidu, so ask your broker for a copy of that note should you wish a quick glance at that ahead of results that are due on Wednesday. One chart that I found interesting last week, which was published in the Financial Times relating to Gavin Davis's article, was in relation to the net US buying of European equities. There really has been, during the course of 2014, a surge of interest in terms of European equities, and this is coming from the US, as this chart indicates, with the US markets outperforming last year, and indeed just a little bit of strength coming back into some of the European currencies. It has certainly been an ideal trade for US investors to seek value over here in European markets. So just take a look at the volume growth, and that puts some explanation of the rally that we've seen of late. In terms of sterling, this one has been on my radar for a little while. The strength of sterling leading it to become one of the strongest, if not the strongest currency over the course of the last few months in those important G10 economies. They shied away a little bit last week. Really two bits of data coming through from the UK. We've obviously seen inflation on the decline and moving more towards the Bank of England targets. This month it is looking at 1.9%, so just under target there. And also we saw retail sales for January. Expected to be poor anyway. January, obviously when you're comparing to December, is going to be a lot lighter, but indeed the numbers failed to meet expectations on retail sales for January, both on a month-on-month and a year-on-year basis, and the net result of that, of course, is that the sterling depreciated on that, very sensitive, of course, to interest rate expectations. Japan has been weak through 2014. It started the year over 16,000, has touched 14,000. It's finding some middle ground just under the 15,000 mark at the moment. Really the indication here is what more can they do to continue the stimulus within Japan at the moment. Certainly the more enthusiastic Japanese supporters out there fully expect further measures to continue the momentum of 2013. So it has engineered some recovery in Japanese stocks from that disappointing start to 2014. Really just to rattle through a few stocks of interest. Centrica results last week where we moved pretty much to a neutral. Have to say that I find better value elsewhere, even though this stock has a 5% yield. Really last week's statement was geared very much towards its British gas subsidiary and the political tension that has certainly been on this stock for the last 6 or so months since Ed Miliband's speech. That has caused the share price to decline from 400 down to about 317. So a bit of a relief rally last week that those numbers broadly met expectations, and they're saying this year that they expect earnings per share to be flat, save the fact that this extreme weather is going to cause them some exceptional costs. One stock with an equivalent 5% yield, which we think is looking much more attractive on the chart, is that of Shell. The chart shows that the company seems to have convincingly now broke out towards the top end of the range, and this is despite the fact that it was only 3 weeks ago this company was warning on its Q4 guidance, and it was a profit warning. The shares initially dipped, but they have rallied, and they've rallied strongly, and it means that they are backing the new CEO to implement some more radical strategy moves at Shell, and I like the way this is moving at the moment. So certainly for the income seekers out there, certainly looking for 4.5–5% yields, then Shell looks a much more attractive momentum play at the moment for investors. In terms of the week ahead, one other stock which we have put a buy note out recently, may well have seen the video we produced on the house building sector and general construction in general. Travis Perkins was one of our highlighted stocks. They report their results this week, and pleasingly the shares have performed well during the course of February in anticipation of these numbers. Really just briefly, it's 600 building merchant chains throughout the UK, quite operationally geared towards momentum in the volumes in the building merchants sort of turnover. And so we're expecting good numbers from them this week. Really the key is how that builds in 2014, with analyst expectations of somewhere between 15% to 17% earnings per share growth. So some real momentum behind this stock at the moment.